Hello, this is Derek Iswell, Chief Investment Officer for Shelton Capital Management with a Shelton Capital CIO Minute. A long report today because there's a lot of economic information that came out this week, starting with the CPI report on Tuesday for the month of November. The overall report showed that inflation is slowing at an even faster rate than is expected, and the market reacted to that, chasing up 2 to 3% returns early in the day on Tuesday. But once investors started to dig a little more deeply into the inflation data that had been released, their mood changed. The Atlanta Federal Reserve does a nice job of providing economic analysis of a lot of economic indicators, but particularly in inflation. And as this chart shows, they split the inflation reports and components into sticky and flexible parts. The flexible parts is what you'd expected, the non-core parts of inflation like energy prices, commodities, food, but also includes housing, which can be fairly volatile as well. And housing right now, while everyone knows that housing prices are likely to come down and rentals, a lot of timely data on rentals are showing that they're coming down, it hasn't fed directly into the CPI data yet, but everyone knows it will, and everyone knows that that is going to be a tampering force on inflation. And so the flexible part of inflation has been coming down, but what hasn't been coming down is the sticky part of inflation, the part of inflation more related to labor and services. It's been north of 6% for several months now and is showing no signs of rolling over or going down. And a lot of this has been priced in. And so once the traders had noticed this part of the CPI report, the markets gave back most of the appreciation that started early on Tuesday in the next 48 hours. That, of course, leads us to the second part report of the week, which was the December Federal Reserve meeting. On the margin, the Fed was hawkish. They raised rates by 50 basis points, as everyone expected, and they reiterated that we should not expect rate cuts anytime in the near future, not until inflation heads towards 2% in a convincing manner. And that could be a while. What I believe is going on here is that Jerome Powell is being very careful not to make the same mistakes of some of his predecessors, particularly what is often forgotten about Paul Volcker's experience with inflation in the 70s is that he had to raise rates twice. He raised rates in the late 70s during a time when the economy was in recession. And once inflation started to abate, he rapidly lowered rates again to try and help combat that recession. And inflation came right back, and Volcker was forced to raise rates a second time, even more aggressively in the early 80s. Jerome Powell has learned this lesson, and I believe he's trying to make sure he doesn't make the same mistake. And that's why he has been so adamant about expecting rates to remain high until we see convincing changes in the rate of inflation. So what now? Well, a half-full perspective on economic conditions would be that things are pretty good. Inflation is coming down. Unemployment is at cycle lows. But on the margin, things are looking a little tough for economic growth. Most leading indicators, housing, manufacturing, the yield curve, are all pointing to a recession in the coming months. And the big question is how deep and when? When will unemployment start to rise? When will earnings growth start to weaken? If you extrapolate some of the lags from economic data that we've seen historically, we're probably talking 6 to 9 months from now, but every cycle is different. And thus, the timing and depth of this recession, if it occurs, is still up in the air. Thanks for your attention. For further information, please contact your local Shelton Capital Management representative. This has been a Shelton Capital CIO Minute.